From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Great to have you with us here at ausbiz. So to the market, look, we're pretty much struggling for direction for most of the day. Very choppy trade. Looks as though we're going to finish around 0.1% higher on the CBO 200. Similarly with the ASX 200, and on that index, in fact, for the week, we're going to end up pretty much flat. And a lot of this action, of course, been driven by what we saw out of China, which certainly lit a fire under the resources sector. So let's take a look at, in fact, the themes for this afternoon. And once again, it is all about the miners. As we've seen those stocks move higher and higher across the week. In fact, that whole sector is up around 10%. Falling Star, well, that does refer to Star Entertainment. It has resumed trading and it has been severely punished. At one stage, it was down about 50% in this morning's trade. And grocery oligopoly, well, almost a duopoly. It is that focus on Coles and Woolies, with the ACCC releasing its interim report and now into the next phase of its inquiry, essentially looking to see whether those two have abused their market power. So let's get into the sectors, a little more detail there. And as I said, the miners are clearly outstanding for the week, in fact, and that is led by the big miners. We have seen the iron ore price bounce higher again. And as I mentioned, this is all off the back of that stimulus we're seeing out of China at the moment. So Rio, BHP, Fortescue, all up handsomely today, and we're seeing that across. In fact, also extending to the lithium miners as well. The mineral resources having a very good day. And elsewhere there among the lithium miners, as you can see, all very much in positive territory. Elsewhere, among the retailers, just a little mixed at this point. A lot of questions around Premier Investments at the moment. It's tied up with Myer, but it's up marginally higher today. And just in terms of the top stories, well, it is headlined by Star Entertainment. As I mentioned, it has slumped severely today. As I said, at one point it was off around 50%, having lost half its value. That's after its resumption of trade on the ASX for the first time since August. It was suspended after the casino operator, well, it hadn't released its full year results. They finally dropped today. Elsewhere, Endeavour Group, among the biggest losers on news that its chief executive, Steve Donoghue, is leaving. And as I mentioned there, ACCC moving into the next phase of its inquiry into the supermarket giants, Coles and Woolies. It will scrutinise whether the supermarkets may be abusing their market power. And funds management company GQG Partners dropping after copping a $725,000 penalty from the US regulator for violating whistleblower protection rules. Well, let's get across what we have seen this week. Plenty to talk about. Shane Oliver is joining us from AMP. Shane, a very good Friday to you. Great to catch up with you again. So as I'm mentioning there, so much this week dominated by what we saw out of China with its stimulus, both fiscal and monetary. How would you describe what we've seen there? Of course, markets have been screaming this for quite some time. Is it too little, too late, perhaps?
That's certainly a risk, but probably not. I think the reason markets have been celebrating is that, as you said, they have been calling for it for some time. There was a lot of scepticism that anything significant would be delivered. But this week we've seen day after day, starting Monday, particularly Tuesday for monetary policy, then yesterday in terms of fiscal policy with the Politburo meeting, we've seen quite a concerted effort. We've seen China move from very incremental, cautious stimulatory moves that really just kept things ticking over to almost a whatever it takes stance, obviously starting on monetary policy, but looks like big things are coming in terms of fiscal policy as well. So there seems to have been a sea change in terms of the thinking process by the government in China and what it needs to do. And markets are obviously taking that seriously. If it was just monetary policy on its own, just lower interest rates and easier money, then I'd be a lot more sceptical, because that could be akin to just pushing on a string. And the problem in China is not that money costs too much or is an absence of it. The real issue has been a lack of demand for it. Whereas a move to fiscal stimulus and propping up the property market to some degree potentially injects demand into the economy. So this is a big change, and it almost looks coordinated around the world. You've got coordinated policy stimulus, China stimulating now nearly 50% of central banks around the world cutting interest rates. Obviously, we are an exception in Australia, but I think we're going to get there fairly soon. And obviously, markets are celebrating on the back of all of that because growth is still okay. And so therefore, investors are sort of celebrating some sort of continued Goldilocks sort of scenario going forward.
We'll get to the RBA in just a moment. Shane, interested though, then, do you feel as though the Chinese were waiting for that Fed move, and particularly given that the Fed went for 50 basis points?
I think that possibly was the case. There's two things that I think kicked them into action. We got some softer than expected economic data out of China last week. That was the first one. And then, of course, around about the same time, we had the 50 basis point cut by the Fed. So those things, I think, sort of cleared the way. The 50 basis point cut made it easier for China to undertake monetary stimulus without a fear that their currency would collapse. And, of course, it's all come together now. So And I guess it's not just the US cutting, other central banks doing the same thing, but that was probably a big factor in it all. And then the realisation, of course, that Chinese growth wasn't getting any better. Obviously, a big one in all of this, and they need to do something ultimately about consumer spending.
Shane, how do you view that move by the Fed in retrospect now, given we're sort of more than 10 days past? Do you see it as an emergency cut, or perhaps that they've got ahead of the curve? And where are you seeing the US economy land?
Look, I wouldn't consider it an emergency cut just yet. If the US unemployment rate was surging and payrolls were collapsing, then you could say it was an emergency cut, but that's not the case. I think the Fed just concluded that there's enough signs of weakness in the labour market, not all indicators, but particularly things like job openings and hiring and layoffs numbers were going in a direction that signalled to them that they needed to start easing, remove some of the tightening in monetary policy. And obviously the lower inflation numbers that we've seen for, I think, 5 months in a row provided them the scope to do that. And they probably concluded, well, maybe we should have started in July. We didn't. We're a little bit behind the curve. Doing 50 just gets us back in line with the curve, so to speak. But I don't see it as an emergency cut. Things aren't that bad in the US. And when you look at the Atlanta Fed's GDP now estimate of growth this quarter, it looks like it's still holding up pretty well at around 2.9% annualised, which in Australian terms is about 0.7, 0.8% quarter on quarter.
Shane, we've seen in response equity markets hitting new highs again, even locally, but certainly we've seen that in Wall Street. Is that euphoria justified, do you feel?
Well, that's the big question in all of this. There is a problem there that share market valuations are quite rich. The gap between earnings yields and bond yields is quite narrow compared to what we've seen over the last 20 years. As you say, I wouldn't call it complete euphoria, but investor optimism is quite high. And you've still got a risk of recession. Jobs leading indicators, like even we've seen in Australia, the job vacancy numbers are continuing to fall. So that risk is certainly there. I guess, though, for investors, they're sort of thinking, well, those risks are all there, but, we are seeing lower inflation. That does mean lower interest rates and ultimately potentially lower bond yields, which should help improve valuations. So providing we avoid a recession, then things should be okay for share markets. The other aspect I think just worth noting is that August and September are known to be the weakest months of the year. We've actually come through those months reasonably well. We had a bit of a rough patch at the start of August and a bit of a rough patch at the start of September, but overall it's been okay. And we're now coming into a stronger seasonal period for shares. So when you put all these things together, lower inflation, lower interest rates, yes, stretched valuations, but if inflation continues to fall and interest rates keep falling, then that valuation pressure might start to ease a little bit, and more positive seasonal backdrop for share markets, then you can sort of understand why share markets have been celebrating over the last week, going to record highs. in global shares, US shares, and also our share market is at around a record high, even though it's fairly flat for the week.
Yeah, as you say, essentially defying history this September. Shane, let's take a look at the Australian economy then. In the wake of the RBA leaving rates on hold as expected. It's all about what's to come next, of course. What are you seeing data-wise? We did get a monthly read on inflation. Look, the RBA seem to be essentially looking through that. It is more interested in what we're seeing at a quarterly level. What do you make of it?
Well, I think the monthly read was quite good. I'm not going to get excited by the 2.7% headline rate, but I will get excited by the chart you've just put up there, which shows trim mean inflation on a monthly basis. So that's our measure of underlying inflation. And it's, the green line, it's come down nicely. It had a bit of a perk-up going into May when it rose to 4.4%. We all got very worried that inflation's, well, some of us did anyway. I didn't get too worried, but there's a lot of concern at the Reserve Bank and among some economists, inflation's going the wrong way. We're different to the US. We're stickier. Blah, blah, blah. But now, we've seen the resumption of a downswing in inflation. We've seen that trim mean, which is the one the Reserve Bank focuses on. So I've stripped out the impact of electricity rebates and all those sorts of things here. We're focusing on the underlying number. The trim mean resumed its downswing. So that's a good sign. And in fact, when you map it against the US core inflation rate, it looks like we're just following the US with a 3-month lag. Nothing to get too excited about. So I think that's a very positive sign. And the Reserve Bank, of course, will want to focus on the quarterly numbers.
Yep.
They'll probably wait till we get 2 good quarterly numbers in a row, which takes us to February next year. But there is a chance here, if the September quarter numbers are good and we get a continued downtrend in monthly inflation numbers, that we may get a cut by December, in December. So I'm certainly not ruling that out. There's certainly a high risk that we could see that, or high chance we could see that, even though my base case is the RBA may not be confident enough to start cutting till February.
All right, I'll call that a 50-50 call from you then, the possibility of a rate cut by Christmas. Shane, terrific to have you on the show as usual and to the end in the week. Thanks for joining us on AMP.
Thanks, Andrew. Take care.
All right, let's catch up with our stock of the day. And no surprise, it is Coles and Woolies. 2 stocks, in fact, given they are the focus and our experts for their assessment. Luke Winchester from Merriweather Capital and Richard Hemming from Under the Radar Report.
If you're looking for growth, then these guys won't give it to you, obviously. But that defensive income investor, I think on this pullback, if you don't have Woolies and Coles in your portfolio already, these are the sorts of levels where you'd be accumulating for those long-term holds. So let's call it a hold for the program.
So what I would say is that these are stocks that have great competitive edges. Like probably, the sites, you can't compete with those sites. I mean, they are just fantastic in your population centres. The data that they get, unparalleled, hidden value. What I would say is these are great stocks for your core portfolio, and we would look at dollar cost averaging, not aggressively, but not buying 10% a go of your overall position, but certainly 2 to 5%, because these are such good stocks to have in your portfolio for the long term.
All right, let's get a look at the leaders and laggards as we round out this week. And it is in the mining space. We're seeing so much movement at the moment, led by Sayona and Mineral Resources. Also some significant movement post that demerger from Webjet. As far as those that are lagging, no surprise that Star Entertainment is top of that list. Also Westgold Resources having come off as well. So tonight, markets will be focused on some key data out of the US, the personal income spending out of the States, as well as the PCE price index, the Fed's preferred measure of inflation. And we'll also get some more Fed speak as well. That is the COB for this Friday. Have a terrific weekend, but don't go anywhere. We've got the last call coming up.